On March 10, 2000, the floor of the Nasdaq Stock Exchange was electric. The index had just breached the 5,000-point mark for the first time in history. In the preceding 5 years, the value of technology stocks had grown by an eye-watering 800%. In the sleek, open-plan offices of Silicon Valley, 24-year-old software engineers were becoming overnight multi-millionaires, buying Ferraris before their companies had even turned a single cent in profit. To the observers of the time, the old economy, one based on manufacturing, physical assets, and boring things like earnings, was dead. We were told we had entered a new economy, a digital frontier where the old rules of gravity no longer applied. But less than 2 years later, that electric atmosphere had turned into a funeral procession. $5 trillion in market value had evaporated into thin air. The Ferraris were being repossessed. The sleek offices were being cleared out by liquidators, and the very word .com had transitioned from a golden ticket to a badge of shame. It was the greatest speculative mania in modern history, a time when the world fell in love with a future it didn't yet know how to build. Today, we are going to peel back the layers of this digital gold rush. We will explore how a simple piece of software triggered a global frenzy, why rational people began to believe that losing money was a sign of success, and how the eventual collapse reshaped the world we live in today. This is the definitive story of the rise and fall of the dot-com bubble. To understand the crash, we first have to understand the miracle. In the early 1990s, the internet was a barren landscape. It was a tool for the military, researchers, and academics. It was text-heavy, incredibly slow, and required a degree in computer science just to navigate. If you wanted to see a picture, you had to wait minutes for it to render line by line. It was a niche hobby, not a global marketplace. Everything changed in 1993 with the release of the Mosaic web browser. Developed at the University of Illinois, Mosaic was the first browser to display images in line with text. Suddenly, the web looked like a magazine. It had a user interface. It was intuitive. For the first time, the information superhighway wasn't just a buzzword for politicians. It was a destination that ordinary people could actually visit. The team behind Mosaic eventually formed Netscape, and their 1995 initial public offering, or IPO, is widely considered the big bang of the bubble. Netscape was a company that gave its product away for free. It had no profits. It had very little revenue. And yet, on the day it went public, its stock price soared from $28 to $75 in a matter of hours. The company ended the day valued at nearly $3 billion. This sent a seismic shockwave through Wall Street. For decades, investors looked at price-to-earnings ratios. They wanted to see a history of growth and a clear path to dividends. Netscape proved that in the digital age, you didn't need a history, you just need a vision. The race was on. Venture capitalists began pouring billions into any startup with a business plan that mentioned the internet. It didn't matter if the plan made sense, it only mattered that they didn't miss out on the next Netscape. By 1996, the frenzy was moving from the boardrooms to the living rooms. The Clinton administration was touting the internet as the engine of a new American prosperity. But more importantly, the Federal Reserve, led by Alan Greenspan, was keeping interest rates low. Capital was cheap, and investors were looking for higher returns than they could get in bonds or traditional blue-chip stocks. This era introduced a bizarre new kind of business logic. Because the internet was so new, no one knew how to value these companies. Traditional metrics were discarded. In their place, analysts created new, questionable metrics like eyeballs, stickiness, and mindshare. The idea was that if you could just get people to visit your website, you could figure out how to make money from them later. This birthed the mantra of the era: get big fast. Startups weren't trying to build sustainable businesses. They were trying to capture territory. It was a land grab. If you weren't burning through millions of dollars a month on marketing, you were seen as lagging behind. Companies like AOL and Yahoo were the darlings of the era, seeing their valuations reach heights that eclipsed century-old giants like Disney or Ford. The culture of Silicon Valley shifted almost overnight. It wasn't about the technology anymore. It was about the exit. Young entrepreneurs would pitch an idea on a napkin, receive $10 million in funding the next day, and be planning their IPO by the end of the week. The goal was to go public as fast as possible, sell your shares to the public, and move on to the next venture. It was a game of musical chairs played with billions of dollars. The bubble wasn't just fueled by professional investors, it was democratized. This was the era that saw the birth of the retail day trader. Before the mid-90s, buying a stock was a slow, expensive process involving a phone call to a human broker who charged high commissions. But with the rise of online brokerages like E-Trade, Ameritrade, and Charles Schwab, anyone with a computer and a modem could trade stocks for a $10 fee. Television networks like CNBC became the soundtrack of the American household. Ticker tapes ran across the bottom of the screen 24 hours a day. Ordinary people, teachers, doctors, taxi drivers, began quitting their jobs to trade tech stocks full-time. There was a genuine belief that the stock market had become a wealth machine that would never stop. The psychological phenomenon of FOMO, the fear of missing out, was at an all-time high. When your neighbor tells you they made a year's salary in a week by buying shares of a company that sells cigars online, it's hard to stay rational. People began taking out second mortgages on their homes to put money into Dotcom stocks. The market had become a giant feedback loop. The more people bought, the higher the prices went. The higher the prices went, the more people felt they had to buy. It was a classic speculative mania, similar to the tulip mania of the 1600s, but powered by fiber optic cables and real-time data. If you want to understand the absurdity of the peak, you have to look at Pets.com. Launched in 1998, their business model was to sell pet supplies over the internet. On the surface, it sounds reasonable, but the economics were a nightmare. Dog food is heavy and expensive to ship. To attract customers, Pets.com sold their products at a discount, often below what they paid for them. They were literally losing money on every single order. Instead of fixing the business model, they doubled down on marketing. They created a sock puppet mascot that became a national celebrity. They spent $1.2 million on a single Super Bowl advertisement in 2000. They had a giant balloon in the Macy's Thanksgiving Day parade. Everyone knew the sock puppet, but nobody was buying enough dog food to cover the company's massive overhead. When Pets.com went public in February 2000, they raised $82 million. Investors cheered, but the math didn't add up. The company was spending nearly $400 on advertising to acquire a single customer who might only spend $20. It was a bonfire of cash. Pets.com would eventually become the ultimate symbol of the bubble, a company with a massive brand and zero business. They went from IPO to liquidation in just 268 days. There was also Webvan, an online grocer that spent $1 billion on automated warehouses before they had enough customers to fill a single truck. There was Flues.com, which tried to create a digital currency endorsed by celebrities, and eToys.com, which was valued at $8 billion despite having only $30 million in sales. The market was full of ghost companies, entities that existed only on paper and in the imagination of hopeful investors. By 1999, the warning signs were everywhere. Alan Greenspan had famously used the term irrational exuberance as early as 1996 to describe the market. But the bubble continued to grow for 4 more years. In 1999 alone, the Nasdaq rose by 86%. This was no longer an investment period. It was a fever dream. Investment banks, eager to collect massive fees, were taking companies public that were barely a few months old. Analysts at major firms were giving buy ratings to stocks they privately called junk in internal emails. The conflict of interest was rampant. The banks needed the tech companies to keep going public so they could make fees, and the tech companies needed the banks to keep hyping their stocks so they could raise more cash. The cultural peak arrived with the merger of AOL and Time Warner in early 2000. AOL, a relatively young internet service provider, used its inflated stock price to buy Time Warner, a massive media conglomerate. It was billed as the deal of the century, the marriage of the new world and the old. In reality, it was the high water mark of the madness. It was a sign that the new economy had finally swallowed the old economy whole. But beneath the surface, the foundations were cracking. Interest rates were finally beginning to rise as the Fed tried to cool the economy. More importantly, the massive Y2K spending spree was over. Throughout the late 90s, corporations had spent billions upgrading their systems. Once January 1st passed, that massive demand for tech products suddenly vanished. The end didn't come with a single event, but a series of cascading failures. On March 10, 2000, the Nasdaq hit its peak. Over the next few days, several large sell orders from tech giants triggered a wave of panic. Then, on March 20th, Barron's magazine published a cover story titled "Burning Up." The article provided a cold look at the balance sheets of the top 200 dot-com companies. It revealed that over 50 of them were months away from running out of cash entirely. The get big fast strategy had a fatal flaw. If you can't raise more venture capital and you aren't making a profit, you die. The panic was a mirror image of the rise. Margin calls forced day traders to sell their stocks at any price to cover their debts, which drove prices down further. It was a violent downward spiral. By the time the dust settled in October 2002, the Nasdaq had lost 78% of its value. Trillions of dollars in retirement savings were gone. The overnight millionaires were suddenly looking for work in a market where no one was hiring. It's easy to look back and call the investors of the 90s stupid, but the truth is more complex. The dot-com bubble was a classic case of being right, but too early. The investors of 1999 believed that we would buy our groceries online, watch movies via streaming, and manage our entire lives through a handheld device. They were 100% correct. They just didn't realize that the technology to make those things profitable, like high-speed broadband and smartphones, was still a decade away. The carnage of the crash cleared the way for a more disciplined era. Amazon survived, though its stock dropped from over $100 to just $7. Jeff Bezos later said that the crash forced them to become hyper-efficient. Google, which was still a private company during the worst of the crash, learned from the mistakes. They waited until they had a proven advertising model before they went public in 2004. They didn't focus on eyeballs, they focused on intent. Perhaps the most important legacy was the physical infrastructure left behind. During the boom, telecommunications companies spent billions laying millions of miles of fiber optic cable. When these companies went bankrupt, the cables stayed in the ground. This excess bandwidth is exactly what made the next generation of the internet, the world of YouTube, Netflix, and Facebook, possible. The rise and fall of the dot-com era was more than just a financial event. It was a cultural turning point. It marked the moment the internet moved from a curiosity to a necessity. It was a time of immense brilliance and immense delusion. But what about you? As you look at the current state of the tech industry, do you see the shadows of 1999 returning? Are we currently in an AI bubble that is destined to pop? Or have we finally learned how to value innovation without the irrational exuberance? I want to hear your thoughts. Were you around during the first dot-com boom? Do you remember the "you've got mail" days? Or did you lose a few dollars on a can't-miss stock? Or, if you're younger, do you see your generation making the same mistakes with crypto or new tech trends? Drop a comment below and let's get a discussion going. If you found this documentary helpful, please hit that like button. It really helps the channel grow. And if you want to see more deep dives into the events that shaped our modern world, make sure to subscribe and turn on the notification bell. Thank you for watching, and remember, in the world of finance, if it sounds too good to be true, it probably is. I'll see you in the next one.